Inflation still wrecks American homes. Prices of essential commodities have gone through the roof, and productivity has dropped for the first time in the 21st century. In recent years, one of the most prominent voices sounding the alarms has been Jeremy Grantham, a renowned value investor and a co-founder of Boston's GMO, warning that markets are susceptible to a significant stock market shock. Regrettably, he was correct. The shock has already occurred. How bad is the state of the economy? What caused the financial catastrophe we're all experiencing now? What is coming in the future of the world's largest economy? Join us as we discuss Jeremy Grantham's predictions as the financial crisis unfolds.
It's done all the things that a super bubble typically does, and it could start its way down anytime, and perhaps a month ago.
We currently have a market that superficially resembles 2000, and he predicts that it will behave that way initially, before unfortunately transitioning into the 1970s, when all assets will be priced substantially lower than they are today due to the deflationary effects on the economy and stock market. GMO, a worldwide investment management company with $100 billion in assets under management, is led by Jeremy Grantham as president and chief investment officer. They are now among the most well-known money managers in the world and a subject matter expert who deserves your attention right now. Grantham noted a recent analysis of his that showed a worrying gap between US growth projections and the country's capacity to sustain such projections due to rising debt levels. Even a slight decline would be difficult for American households and politically risky for the president, even though the president once claimed the probability of having a recession is extremely slim. According to Bernanke, the fact that the housing market in the United States has never declined shows how strong the market is in this country. According to Grantham, the US economy could experience a painful stock market correction comparable to what stock markets went through in the early 2000s. It's very tempting to look at the short-term issues like the Russo-Ukrainian war, the lockdowns, and the Federal Reserve, and blame them for the financial havoc that has wrecked the United States and rippled out to the world. All three of these factors make it certain that our issue will be difficult to solve in the short to medium future. However, there are longer-term problems which have gone largely unnoticed, and that is what we're discussing today in this video. High levels of debt. The first point is debt. The average American owes about $94,000. This means the entire debt profile of the United States accumulates to $31.4 trillion. Even top officials of the US government have admitted that this is unsustainable. Having a lot of debt is extremely risky and should be actively discouraged. Top management, such as the Fed and others, should be responsible for that. Let me give you an example. What makes you prefer low rates? It promotes debt. What makes you want more debt? Because it promotes development. That is the plan. So allow me to present the most comprehensive statistical analysis that we began in 1985. Due to technological advancements and the subsequent development of increasingly complex financial products, the ratio of debt to GDP has been gradually rising rather than sharply expanding. Then, in 1985, it flies over any page at a sharp 45-degree angle and increases from roughly 1 point times GDP to well over 3. So, in that little window of 35 years, the debt to GDP ratio tripled. The world's largest and most significant economy tripled their debt profile in such a short time. If that goes on, how does growth then proceed? There are lots of other variables at play, but there isn't much place in that equation for the notion that greater debt leads to faster economic development. The data do not support the claim that this is true. Like most of modern economics, it is based on assumptions, yet the statistics do not support it. We dare say that there is absolutely no proof that higher rates of macro debt to GDP are related to growth. But occasionally they do have everything to do with higher risk. Jeremy Grantham points out that we have a great display that looks at the link between all the different industries, utility use, etc., while we're selling our resource portfolio. The only time the link declines is when resources are available, and resources decline to such an extent that the 10-year correlation is negative based on data from the previous 80 years worth of rolling 10-year periods. It's that obvious. The next point has to do with the second largest economy and its vital role in world trade: China. China's declining population. One is that China, where 500 million additional farmers cause globalization, is running out of people. China has been experiencing dwindling cohorts of 20-year-olds for the past 20 years, and since we know the baby cohorts are dwindling like a stone, there will soon be a labor shortage that will affect the entire world. That is not a small hurdle. Everyone within and outside the industrialized world, plus China herself, will suffer for the labor shortages. Let's take a quick trip back in time to examine the economic history of China. Following the bubonic plague, there was a 100-year honeymoon period, during which wages rose dramatically to levels that would not be attained for several hundred years during the Industrial Revolution. In the last 20 years, the most valuable commodities have tripled in supply. No doubt this is due to the rise of China. The competition is constantly between technology and scarcity, which for a century we've triumphed. We've reached a stage where we've gone through that stuff and are now at a point where technology is 2 paces up and scarcity is 3 paces down. Previously, it was worse. For the past 20 years, the evidence has been screaming at us that we're starting to run out. Of course, a war isn't necessary, and today's world is so fragile that all it takes is a rough sneeze to send price spikes, brief outages, and bottlenecks around the globe. We'd better get used to it. We're going to live in a world with more and more shortages and bottlenecks, and the same is true for food too. In the past 50 years since it began, the UN Food Index has never been higher than it is right now. Okay, there is long-term price pressure on labor, and there is price pressure on raw commodities, metals, and food. The hazards of a debt bubble bursting and the remainder of an equity bubble bursting have simply not been understood by the Federal Reserve. It brings doubt on why the Fed should even exist, and it feels like a new period in which inflation will be much like it was in the 20th century. They're really gullible. They aren't even interested in the concept, and it would seem they don't even have a clue. Some claim that the US home market has never decreased, and that this is simply a reflection of the robust US economy that Alan Greenspan is promoting. They haven't realized they're playing with fire until now. Therefore, if you understand the inflation statistics, you're aware of how well resources perform, but you should also know of its somewhat negative correlation with the rest of the portfolio when it is highly negative. As we can see today, when they do well, it burdens the rest of the economy, and when they do poorly, they inflict more pain. Therefore, there is a very strong case here for a resource portfolio on resources. Analysts like Paul Donovan argue that inflation gives people the incentive to spend now rather than later to avoid losing their savings. People were buying stuff, and the reason people were buying stuff was that throughout the pandemic, you'd not been able to go out and buy stuff. Sitting at home in general during inflationary periods, typically your currency loses pricing value, impacting your investment strategy. This affects every person and every business throughout their decisions as to what they need to buy or how much they will pay for a commodity they sell. This also affects structured financial investments that generally invest in things affected by the economic downturn, like bonds and treasuries. Let me give you a basic example. Imagine you have an investment fund at 15% interest, and then there's inflation at 5%. The genuine interest on your invested money is only 10%, not 15%, since you have to account for inflation. So what has changed after the 2011 financial crisis, when China's rapid industrialization slowed down? The resource industry is suffering as a result of iron ore and coal growth rates that have dropped from double-digit to zero, dead flat for 3 years in a row. It seems like the worst is over, says Grantham. He claims that the market is dazzlingly inefficient and deviates greatly from fair value, and that all bubbles burst and that all investing crazes fade. But eventually, after taxing your patience and breaking your heart, it will return there. So your mission, should you choose to accept, is survive up to that point. Wealthy people understand how to protect their hard-earned assets. That's how we stay afloat in these times. Thanks for watching this video. Don't forget to like, share, and subscribe for more insightful updates on the state of affairs. See you next time.